Okay, picture this for a second. Your company, it just announced record-breaking sales. Your most important division, it's growing at its fastest pace in over 3 years. Everything looks absolutely perfect. And then, bam! In a single day, the market just panics and your company's value collapses. Now, this isn't some hypothetical. This is exactly what just happened to Amazon. So let's get into it.
In one single trading session, Amazon's market value plummeted by over $220 billion. No, that is not a typo. We're talking about an amount of value larger than the entire economy of some countries. Just poof, gone.
And here's the really crazy part. This didn't happen because of some bad news. I mean, Amazon Web Services, their cloud computing juggernaut, just posted its fastest growth in over 3 years. And overall sales, they beat expectations. The business was absolutely firing on all cylinders. So the reaction from Wall Street, it makes no sense, right? Not on the surface anyway.
Which brings us right to the heart of this explainer. What on earth could possibly cause such a massive disconnect between how the company's doing and how the market thinks it's doing? Well, the answer isn't in what Amazon did, but in what it's about to do.
You know, the real reason for all this panic wasn't buried deep in some complex earnings report. Nope. It all came down to one single, absolutely staggering number about the future. A number that sent some serious shockwaves through the financial world. $200 billion. Let that sink in. That is Amazon's planned capital expenditure for 2026. This is the cash they're going to spend on stuff like data centers and equipment and all the infrastructure. And it wasn't just a big number. It was $55 billion higher than what anyone on Wall Street was even remotely expecting. A huge surprise. And if you're trying to wrap your head around that number, get this. Amazon's planned spending for just 1 year is more than the entire market value of Nike. It's also more than the combined spending of the whole U.S. energy sector. We're talking oil, gas, refineries, all of it put together. This is not just a big bet. This is a historically massive one.
So the big question is, where is all this money going? Well, this chart here tells the whole story. A colossal 65%. 65% is being poured directly into AWS data centers. Then you add in the spending on their own custom AI chips and the energy to power it all, and you can see this isn't just a big investment. It's an all-in gamble on the future of artificial intelligence.
And here is the financial whiplash that just spooked investors. While their operating cash flow, so the money from their core business, was up a really healthy 20%, their free cash flow absolutely collapsed by 71%. So to put it simply, they're making more money than ever, but they are spending it so unbelievably fast that the actual cash left over for shareholders has pretty much vanished.
Okay, so this brings us to the skeptical view, what we call the bear case. This is the argument that this isn't some visionary investment at all. In fact, it might be a recipe for destroying shareholder value on a scale we've just never seen before.
The bear case points to some pretty terrifying numbers. First, check out this brutal disconnect. For every $1 of new AI revenue they bring in, they're spending $10 on AI infrastructure. At the very same time, the profit margins at AWS are shrinking. Bears are also worried about what they're calling a depreciation time bomb. All this new equipment is going to lose value fast, and that's going to crush future profits. Oh, and to top it all off, a lot of this spending spree is being funded by massive debt. You can kind of see why investors are freaking out. But, of course, there are two sides to every story. So let's flip the coin and look at the bull case. Because from this perspective, we see a completely different picture. One where all this spending isn't just necessary, it's actually brilliant.
Amazon has a really compelling counterargument here. First off, the demand is very, very real. AWS has a backlog of $244 billion in committed spending from its customers. Second, they see AI as a winner-take-most market. That means the companies that build massive scale first attract all the best data and talent, and that creates an advantage that's almost impossible for anyone else to catch up to. So for them, not investing now means becoming totally irrelevant later. And, we've seen this playbook before. People said the same thing when they spent billions on fulfillment centers, and now those are an unbeatable advantage. Plus, by building their own AI chips, they can control their own destiny and lower their costs in the long run.
Now, to really understand what Amazon is doing, we have to zoom out a little bit, because this isn't happening in a vacuum. What we're really watching is an industry-wide AI arms race, and Amazon is just one of the major players.
Get ready for this next number. If you combine the projected 2026 capital spending for the top 5 tech giants, we're talking Amazon, Google, Microsoft, Meta, and Oracle, you get over $600 billion. $600 billion. That is more than 4 times the annual spending of the entire U.S. energy sector, all being poured into tech infrastructure. It's just wild.
And as this chart shows, Amazon might be leading the pack, but they are definitely not alone. Alphabet, which is Google's parent company, is hot on their heels, and Microsoft isn't far behind. This isn't just one company's big gamble. It is a full-blown spending war across all of big tech to build the foundation for the entire AI era.
Which brings us right back to the ultimate question. Is this a visionary investment that's going to secure dominance for the next decade, kind of like the build-out of the internet did? Or is it a reckless, value-destroying arms race where the only real winner is NVIDIA and shareholders are just left holding the bag?
So, the final verdict is still out, but now you know exactly what to watch. The key things to keep an eye on will be AWS's growth rate and its profit margins. But really, the most important number of all is going to be that free cash flow. When does it start to recover? The answer to that question will ultimately tell us whether we are witnessing a moment of pure genius or a truly historic mistake.